The average person in the United States in their late 20s has roughly $10,000 saved for retirement. With this amount invested, it's worth exploring how much dividend income you could expect and how it might contribute to your financial goals. While $10,000 won't be enough to fund a typical retirement, you might be surprised at how much it could pay in dividends alone. It could potentially supplement your income or even finance a vacation. Let's take a look at different scenarios that would provide varying levels of income and learn about a major mistake some investors make. There are various investment options available that offer varying levels of dividend income. One of the most common investments is the S&P 500 index, which provides exposure to 500 large U.S. companies known for their stability and profitability. It's a well-balanced index that owns parts of each sector and industry that comprise the entire stock market. The S&P 500 has a long track record of healthy returns and is highly recommended by Warren Buffett. However, it's important to note that many of the largest holdings in this index are technology companies that pay little to no dividends. With a $10,000 investment, you would only receive a dividend yield of less than 1.5%, which translates to around $150 per year or $12.50 per month. Another common investment is the Dow Jones Industrial Average, or the Dow. This index is also frequently referred to as the market, second only to the S&P 500. The Dow comprises 30 of the largest U.S. companies and is seen as a second indicator of how the United States economy is doing. An investor could purchase a fund that tracks the Dow, and they would receive a slightly higher dividend yield than the S&P 500, at just over 1.5%. Another option to achieve a higher dividend yield would be to invest in a fund that provides higher income and less capital appreciation. Many high-quality options hold stocks of stable companies with a long history of dividends. One example is the Invesco S&P 500 High Dividend Low Volatility ETF, which provides a dividend yield of around 4%. This fund only holds the companies in the S&P 500 that pay the highest dividends. While growth is much lower over the long term, a $10,000 investment in this fund would yield around $400 per year, or $33 per month in dividends. Many other high-dividend funds are available that are ideal for older investors, as they provide more stability and perform better during bear markets and slightly worse during bull markets. Another way people can achieve higher than average dividends is by selecting a sector or industry-specific fund. A fund only holds companies in one sector or industry, such as energy, real estate, and healthcare. Some sectors provide higher dividends than most due to the nature of their business. For example, the energy sector is priced relatively low. It has a high dividend yield of over 3% because many investors are scared away by the volatility due to economic fluctuations, renewable replacements, and regulations. Additionally, real estate investment trusts are also considered slightly risky, and because of their business structure, they pay the majority of their profits to shareholders in the form of dividends. The Vanguard Real Estate ETF also has a yield above 3%. Investors willing to research and purchase sectors that have fallen out of favor can achieve high returns in the form of dividends and capital appreciation as the sectors rotate back into favor. A $10,000 investment in Vanguard's real estate or energy ETF would provide about $300 per year or $25 per month in income. Another option is to purchase individual stocks. Many finance experts recommend purchasing index funds or ETFs if you're a beginner investor and don't have a large portfolio. It will help you learn about market behavior, receive stable returns, and grow your portfolio without taking too much risk. Eventually, you might decide to select individual stocks if you're willing to do the research and take the risk. If you decide to purchase individual stocks, looking for a history of dividend growth might be a good idea. For example, the list of Dividend Aristocrats is a good place to begin, as each aristocrat has a history of increasing its dividend for 25 consecutive years. A dividend aristocrat such as AbbVie currently pays a 3.7% dividend. With a $10,000 investment in this company, you'd receive about $370 per year or $31 per month in dividends. Furthermore, it's smart to screen those prospects by their fundamentals, making sure they have reasonable payout ratios around 50 to 60% or less, positive earnings, and various other potential metrics. It's important to remember that there are deals to be had with individual stocks because they often get sold off, whether it be due to recent bad news, earnings miss, or new management. This could present an opportunity because the stock market tends to overreact. A savvy investor must assess the severity of the news and decide on the stock price. Since most investors with $10,000 are a ways off from retirement, they should seriously consider ignoring dividends entirely. Why? Because investing in growth stocks has the potential to make you much more money over the long term. Since dividend-paying investments historically have lower overall returns, those who are still young should typically seek growth. A 2% difference in your annual rate of return can make a huge difference over a career. For example, someone who invests $10,000 once at age 25 and earns an 8% rate of return until age 65 will have $217,000. If they had earned a 10% rate of return, they would have $452,000, more than double the money. It's important to consider that growth stocks are sometimes more volatile, which can be difficult for investors new to market fluctuations. One fantastic option for younger investors is an ETF such as Vanguard's Growth ETF, or VUG. As the name suggests, it holds large-cap growth stocks such as Apple, Amazon, Home Depot, and other large stable names. Over the long term, a growth index will likely outperform the S&P 500, which is ideal for someone with many years until income will be needed. The dividend yield from VUG is less than 0.5% because most of the holdings pay little to no dividends. Instead, they reinvest the profits within the business to continue growing rapidly. Because of this low yield, a $10,000 investment would yield less than $50 per year in dividends, or about $4 per month. Many quality options similar to this fund provide returns that historically exceed the overall market. Too often, people become obsessed with dividend yield and choose the wrong investments for their timeline. Generally, an investor with a portfolio of around $10,000 would be better off focusing on growth, ignoring dividends entirely. How much difference would the income make in your life, whether it be $50 per year or $400 per year? That amount isn't likely to amount to much when paying bills and funding your everyday expenses. Growth stocks will provide you with more money in the future when you're getting ready to retire. At that point, you could switch your growth investments over to income investments if it makes sense. Don't make the mistake of focusing primarily on dividend yield early on. If you found this video helpful, make sure to like and subscribe for more content on personal finance and investing.